everybody. Welcome to Economics with the Honorable David M. Walker, the former Comptroller General of the United States. Today we have a very special presentation, which we do once a year, which is not by David Walker, who gets the day off. Instead, it's by Dennis Stearns. And Dennis is actually the CEO and founder of the Stearns Financial Group in North Carolina, where he's managed over $1 billion in assets. For the chess players who are listening, he's also a chess expert as well. And I can tell you it's pretty difficult to do both, but he's managed to do both. I myself have actually known Dennis for, I admit, nor did I, about 50 years, which will show our age. But he has a great presentation. I saw it many years ago when I was in Raleigh, and it's one of the best presentations I've ever seen when it comes to predicting the future of economics. So with that, and the economy, which this year is going to be a real wild one. So I'm dying to see what he's going to say, but I'm not going to die about it. But I will want to see what you have to say, because Dennis, this year is going to be a very different year with Donald Trump heading the White House. So I'll bring your presentation on and you can let her roll, Guy.
Absolutely. Thank you, Nick. Hello, everyone. We definitely are sailing in some uncharted waters. And so let's jump right in here to one more page. So this is the agenda, keeping an open mind. Difficult to do, I think, in these times of polarity, but we'll talk about that in a second. And then go over some of the potentially good trends and then the potentially bad trends. So we have tailwinds and headwinds and crosswinds. And we have these wild cards, and they are wilder than usual. In fact, G0, Ian Bremmer's group, they call it the wildest since perhaps even World War II on the geopolitical front. So we'll get into some of our advice as we go. Let's go to the next page. So this just shows consumer sentiment by party affiliation. So what you're looking at here is in Trump 1, on the left-hand side of this chart, the red line, when Trump took office, Republicans in general became very bullish. So you see that red line go way up. And then you see over on the right-hand side, when Biden takes office, that red line goes way down. Then you look at the blue line on the left, Trump takes office, it goes down. And then when Biden takes office and the blue line goes up. And although not as high as Trump did for the red line in his first administration. So what this is showing is that people actually believe that the president is changing things in terms of economic sentiment. And the cautionary tale here is that in Trump 1, his first administration, a lot of people thought that oil stocks were going to do great because he likes fossil fuels, and green stocks, or wind, solar, et cetera, were going to do lousy. It was exactly the opposite. Oil stocks didn't do as well. Green stocks did great during Trump. And then in the Biden administration, everybody thought, oh, green stocks are going to do great because it's Biden, and oil stocks are going to do bad. Nope, exactly the opposite. So again, I caution folks, be careful how you vote in terms of your investment dollars for the party that's in office right now. Next slide. Let's go one more. So some of the good items, now these are predominantly U.S. We'll have some international for our friends around the world a little bit later. But in the U.S., we have strong profit margins. In fact, they're almost record numbers. We have a very resilient economy. We have gone from rolling recessions to rolling recoveries. We have deregulation on the horizon because of Trumponomics. We have a potential decrease in the corporate tax rate because of Trumponomics. And we have productivity gains that will continue courtesy of artificial intelligence, augmented intelligence, as Copilot likes to say, and a whole bunch of other techno-industrial revolution things that are kicking into gear as we speak. And then finally, a less tight labor market which is helpful in terms of finding the right people going forward. Next slide. So here are the profit margins. And again, this goes back to 2005, pretty healthy at the current time. And if you think about Trumponomics providing two pieces of tailwinds that we just talked about, deregulation being one, potentially lower corporate tax rates, that will help the number on the far right possibly go higher. Now, one item we will get to on the potential bad is tariffs, and that will be more of a headwind. So if it weren't for the tariffs piece, it would be the potential to go to extreme record highs on profit margins. Next slide. So earnings per share growth for the S&P 500, the 500 largest stocks in the U.S., you can see is on an uptick over on the right-hand side of the chart. And that uptick, if you go to the next slide, is caused by these factors. So this is KKR's forecast, and it's fairly similar to at least a half a dozen other credible sources we look at. And so the long-term baseline of earnings growth, 5.3%, they're saying that lower oil prices could add 3% to companies' bottom line. And remember, oil, petrochemicals are in almost everything. So this is not just oil companies. This is a lot of companies that any kind of petroleum is in their process, or they're using natural gas for different energy sources, including their fleets today. You can see that there are other things that are adding on a positive vein. And then US dollar strength, again, that's for folks in this country buying things that are unhedged. Actually, a little bit of a negative, not much. But when Trump got elected, the US dollar soared. And that is not Trump's preference, by the way. Trump was hoping that the US dollar would go down over his presidency to make our manufacturers more competitive in the US. So far, it's gone the exact opposite way. So 11.4% is KKR's forecast. A number of other ones we're looking at are anywhere between 9 and 14% earnings growth in 2025, which earnings growth are the long-term underpinning of stocks. That's why stocks have been one of the top 3 ways to make wealth for decades and decades. Next slide. Now, this is KKR's proprietary cycle indicator. It's a little busy, but what it's saying is these dots, the red dots, green dots, you have one blue dot in credit spreads, and then you have an orange dot, that if you took all those dots, which are their forecast for where we are today, and mush them together, you end up with that triangle, sort of a square on its side, over on the left, KKR's indicator in November 2024. And so essentially what they're saying is we're in the early innings. For you baseball fans, we're in the early innings of an economic recovery, again, rolling recovery in many cases with different sectors in the economy. That bodes well for a lot of different things. Next slide. And U.S. labor productivity growth, this is the one that came out of a slump in the 2010s, but you can see in the last 8 quarters, it has moved up to levels that we haven't seen since the 1990s or even the 1960s. And let's go to the next slide. And this is pretty stark. So this is the United States coming out of the pandemic, the dark blue line on the top, and then a whole bunch of other countries that are sort of crowding into that middle zone. And so this is part of the reason that we're seeing record profit margins, productivity growth. And again, most economists call this the secret sauce of the future. Next slide. So what could those productivity gains mean in terms of economic impact over the next 10 years? Well, here's a few forecasts. You have over on the far right, PricewaterhouseCoopers, PwC, big accounting firm, basically saying they think that artificial intelligence, augmented intelligence, different facets of that will add 20% or more to whatever growth we would already have. Now, you can scan over to the left, you see the JPM, that's JP Morgan, the one in orange. That is something that we think is maybe a little bit more realistic, but given some of the projects we're working on with different kinds of companies right now, we wouldn't be terribly surprised to see the Accenture, McKinsey, or Goldman, or even the PwC forecast to the right of that come true. Next slide. So this is our playbook, if you will, for where to play the infrastructure build out for artificial intelligence. And we do this broadcast on the heels of a introduction of an artificial intelligence tool from China. It roiled the markets, and particularly that stock that's listed right in the middle where it says design of advanced GPUs, including NVIDIA. And NVIDIA had a massive 17-18% sell-off yesterday. It's stabilized and recovered a bit today. But the thought process was, if China can come up with advanced chip technology for artificial intelligence and do it with cheaper types of chips, and not have to spend the same kind of money that some of our companies in the US are spending, that is probably not good for NVIDIA, the leader at this point in artificial intelligence. Now, we've talked to a number of people since yesterday's announcement. I think the bottom line is not so fast. There's more to learn about this, and there's different gradations of advanced chips, what they can do and not do in data centers and other places around the world. So we think that this entire construct is still well in play. We're not just investing in stocks that are purveyors of artificial intelligence. We're investing in companies that can take advantage of it. In fact, that's where we think some of the best bargains are, companies that can tech enable and up their game, whether it's the warehouse, their sales process, their internal controls, whatever. We also are big investors on the real estate side. So we have a number of investments in data centers and other things that are using the advanced chip technology. So again, I would say from a diversification for this future trend, what you're looking at on the screen is kind of a good roadmap for diversification. Next slide. So the things that can be invested in for capital expenditures or CapEx, certainly data centers, as I just mentioned, the onshoring of manufacturing, they're creating new electricity demand. And we have a client working with a major energy purveyor to build a plant, an energy plant that will provide energy in one state only for artificial intelligence. And that is being replicated a lot of places. Microsoft has cut a deal on the old 3 Mile Island plant. Replacement cycle CapEx, meaning investing money towards renewable and or more efficient traditional energy, driving the replacement of existing coal assets. Interestingly enough, several of our sources believe that item number 2 there is on the Trump agenda, even though it's not been talked about as much as drill baby drill in the petro sector. Item number 3, Boston Consulting Group basically said that because of this trend, global power demand is set to quadruple from 2020 to 2040 compared to the previous 20-year period. And that's going from a lot of new energy needed to a stupendous amount of energy needed. Item number 4, what areas of infrastructure are attractive? These are also areas that we are major investors in. Timber, farmland, toll roads, not particularly exciting or sexy, but very dependable in terms of returns, and natural gas infrastructure, particularly liquefied natural gas. So there's a lot of areas of infrastructure, even beyond AI, that we think are good to invest in. They have potential high single-digit returns, maybe even low double-digit, but with very low volatility and not as much correlation to traditional stocks and bonds. This is an area we like a lot. Next slide. And this shows the last 10 years of returns and correlation. So the way you read this chart is each of these areas of private alternatives, a lot of them infrastructure. On the left-hand side, you see what the return has been per year over the last 10 years. And you can see that some of them high single digits, some of them even low double digits. You can see right in the middle of the page, infrastructure, kind of right on that 10% line. The size of the dot is the amount of income that each one produces. Now that's income is included in the total return number on the left. And the real key here is to look down at the bottom. The bottom is the trailing correlation to a normal 60% stock, 40% bond portfolio. And so if you look all the way over to the right, you can see 1.0. Well, if there was something, none of these are at 1.0, but if they were, that would mean that it zigs and zags exactly with the stock and bond market, which might be okay as a diversifier. But what is really the key, and this is why major endowments, foundations all over the world are paying attention to this chart, is the lower correlation. So you go down that bottom. I mean, if you get to 0.0 correlation, that means you have a day like yesterday where huge risk off day, even though 53% of US stocks actually were up yesterday, including Apple, interestingly, but a lot of stocks were down a lot along with NVIDIA. You get a day like that and these things don't even know it's happening. I mean, they are very steady longer term assets. Next slide. The job market in the US still pretty good. But we've included some quotes here on things that are creating a little bit of churn underneath the surface. So there's a lot of people, and I was just on a call today with a client, coaching them on a career shift they're looking at, who, for whatever reason, the company that they're with right now has been changing up what they're doing, and they want a new career. They want something that aspirationally 70% of the time they can be in flow, things that they enjoy doing, and only 10% of the time be in things that they utterly dislike. And it's amazing how many people today in companies in the US, and this is true overseas as well, don't even get close to that 70% great, 10% not so great. A lot of them are equal weight on the great and the not so great. Factories in the U.S. are struggling to find jobs, fill jobs, and worker shortages still persist. And so the advice that we continue to give, the TED Talk that I did a number of years ago, this techno-industrial revolution, everyone who's working needs to be indispensable and sharpen their axe, because there's a lot of job elimination coming. Now, interestingly enough, Davos, Switzerland, where we've just had a meeting of a lot of economic leaders, CEO of Salesforce said that he believes, and they are one of the huge power users of artificial intelligence, he believes that there will be more jobs created than jobs destroyed. But it wasn't so long ago at Davos that there were some also smart people who said, nah, it's going to be the opposite. It'll be 60 or 70% destroyed for every 30 or 40% of jobs that are created. So again, jury's still out on this. And if you're working or advising your children or grandchildren, again, that be indispensable piece, sharpen the axe, be all you can be is good advice. Next slide. The inflation outlook in the United States has really calmed down. So, we had a variety of supply chain snarls in the pandemic. We had government kind of going overboard, as it turned out. Armchair quarterbacking is easy, but they went overboard on shoving money into the system, and it created that bulge in the middle of inflation. But you can see that a lot of those extraneous bulge areas have calmed down now, and we're kind of at core services that are stickier as far as inflation is concerned. Next slide. Now, this is kind of an interesting one. So Americans are now spending the same percentage on food as they did before the pandemic. It has come back down to a bit above 7% of their budget. What's interesting is that there's some 60% of Americans who don't believe what you see on the screen. Now, some of them may not believe it because they think anything that's issued out of the government is fake news. But a lot of them don't believe it because they are in what's called the gig economy, working a number of part-time jobs. And maybe as prices have risen, their employer hasn't raised their income to keep up with it. They also, you have a lot of retirees who really rarely do the math of, okay, my portfolio is up a lot, particularly 2 back-to-back years of 25% returns in the stock market. My portfolio is up a lot, and my Social Security has gone up as well with inflation. And so if they did the math, and we do this hundreds of financial plans every month, we do this math, and guess what? They're back down closer to 7%. Next slide. All right, now I'm going to get to some of the things that can create headaches for all of us in 2025. First, for the stock market, stretched valuations. So in the first Trump administration, the starting valuation for the S&P 500 U.S. stocks was 16 times earnings. That's pretty much average for the long term. The beginning of Trump 2 is 22 times price earnings ratio. And in Trump 1, it was pretty certain that he was going to be doing a major tax reform move, including taking corporate tax rates way down from where they had been. So that was almost an automatic tailwind for the U.S. stock market. Well, this time, as we talked about a little bit ago, maybe there will be additional corporate tax cuts, but there are headwinds and tailwinds, and starting at 22 times earnings, starting point matters. Valuation on anything, stocks, real estate, you name it. We have an ultra low equity risk premium. Okay, what is that? That compares stock valuations to what we can get in bonds and the bond market. And because Trumponomics has been viewed as largely inflationary, the bond market on the longer end has moved up significantly since Trump got elected. So we're nearing 7% mortgage rates. And every time that longer term interest rate increases, it creates headaches for companies. It also creates headaches as we're doing refinancing of the U.S. federal debt. Tariff headwinds, again, that's the one that everybody knows about, and generally 3 times a day that somebody will be threatened or get a tariff under Trumponomics. And so we're going to show some scenarios on this. We actually think this, despite all the rhetoric, will end up being maybe only a little worse than Trump 1, and not to the levels that have been threatened. But I would say that this is an area of some uncertainty. Inflation pressures, again, Trumponomics in general, particularly some of the tariffs, have inflationary pressures, but there are other things bubbling out there. So we'll talk about that. And then Fed slowing interest rate cuts. This is what spooked the securities markets over a month ago, is that the Federal Reserve came out and said, well, because of Trumponomics, we're not so sure that inflation will stay down. And so we're going to not cut as many times in 2025 as we were originally planning to. That was not received well by the investment markets. Next slide. So there's your valuation of the S&P 500. And again, you see on the right-hand side, we're not as high in valuations as we were, say, back in the late 90s. You know, this era has been likened to the late 90s. And we're not quite as high there. And the other thing to remember is that some of these earnings coming out of the big companies are real this time. Some of them were vaporware back in the late 90s. And so, you know, that is definitely a counterweight to the valuations that we're looking at here. Next slide. But this is the one that should convince you that if you've been playing the stock game and making all these outrageous returns lately, it might be a good idea to do some rebalancing. Every one of these valuation metrics, with the exception of price to free cash flow on the bottom, and it even is moving up towards red range, is historically pretty high. And so when you get to a price to perfection market, you have things like yesterday happen. You have situations where it just takes something small to put a little cold water on the animal spirits, and you see big downdrafts in select stocks or sectors of the stock market. Next slide. So all those valuation things boil into this chart. We showed this a year ago on this same show, and you can see U.S. equities right in the middle there, assumed 10 to 15-year annualized return, 3.2%. That number a year ago was a couple percentage higher. And so that's just a nod to the fact that, you know, we've had a 25% up here again in the U.S. stock market. You see some of the things that have done well in the last 20 years, looking out the front windshield, you know, a few like corporate bonds, 10-year treasuries, likely to maybe do a bit better going forward. But what this suggests is lower overall returns coming. And if you assume 2.5, and we know a lot of smart people who assume 3, but if you assume 2.5, the amount you're making over inflation, 2.6%. Well, for some people, that's still fine. Now, to that U.S. equity piece, let's go to the next slide. So last fall, Goldman Sachs came out with a somewhat similar to what we were just looking at forecast, and they issued a lost decade forecast, which just the term made headlines all around the world. And they basically said, we think the S&P 500 could have a high of 7% a year for the next 10 years, a low of -1, and the average would be 3. And we think 3% inflation may be on the cards. And so that means a 0% real rate of return over inflation. That has kind of a chilling effect. So go back to the year 2000 when we hit the peak of the dot-com era, and the corrections that happened for the next decade, basically a lot of stocks went nowhere, or they went a lot of places, but they weren't positive, and they only got back to where they were 10 years earlier. Now, the interesting thing is the Goldman Sachs, number 2, believe the good factors, some of the things we talked about earlier, could create a 10% plus upward move in 2025. So this is what makes it tricky. It's, okay, when are they taking the punch bowl away? Some of these earnings, as I mentioned, and profit margins really good. And to the extent that they can keep productivity gains going, maybe this party goes on for longer than people think. Well, guess what? That's exactly what happened in the late 90s. Now, number 3, Ed Yardeni, on a major research call with him this morning, and he's a really smart guy, and he believes that some of the tailwinds from productivity gains could really boost returns up in U.S. stocks more into the 6 to 10 range. J.P. Morgan came out not long after the lost decade forecast and said, well, we think it's maybe in the 6 to 7% range because of those productivity gains. So, all of which says that if you've been letting some of your stocks run, maybe particularly if they're in your core portfolio as opposed to your Explorer, where maybe you don't care, you can let profits run. But if they're in the core portfolio, you really need to think about, taking your cheese slicer out, slicing some of the profits off, using hedging techniques, costless collars with options, whatever, to basically hedge some of the risks that are in the market right now. Next slide. So this is a very busy slide, but essentially on the right-hand side, what it's saying is that Trump's tariff proposals are massive. I think we all know that. And they could create an impact that shaded area up and down that could be pretty significant. But if they were cut in half, which we tend to be in the camp that thinks that's probably more likely, that's your bottom right chart. It's not great for a lot of companies, but it's not a disaster either. So it was last fall that the CEO of Walmart said because of falling inflation, they were going to roll back prices, meaning reduce prices on over 7,000 items. Well, recent earnings call, he basically said, never mind. he basically said, because of Trumponomics and uncertainty around tariffs, we may hold on some of that and reserve the right to increase the price of some of those goods. Next slide. Now, this is a global look. So on the far left, you have U.S. stocks and the average price to earnings ratio, meaning the valuation over the last 25 years. And so you see the range of valuations, and you see that turquoise box on a catty corner. That is the current U.S. stock valuation, which we talked about a little bit ago. And then you see how far above the average that is. So again, price to perfection. Now you look at some other areas, Europe, the UK, we're about average. So, more like 14 times earnings. Japan, actually below average. Emerging markets, right on the average line. China, below the average line. Now, the question is, Europe has had a lot of challenges that have created the perception and in some cases reality that productivity gains and other things are not going to be as forthcoming from European companies. But the reality is that valuation matters. And when something gets to the point that everyone thinks it's stinky and bad, there's a lot of research out there that says that actually could work out really well if you've got a 5-year plus time horizon. Now, again, I think Trump administration, there's going to be more headwinds than tailwinds on international stocks, but that's already been priced in to a lot of companies. Next slide. So inflation reality check. Trump was originally saying on the campaign trail that he was going to work on bringing down grocery prices. He sort of backtracked on that in his Time magazine interview in December. And he is hoping that folks will have lower inflation via lower energy costs and better supply chains. Now, again, that supply chain piece, almost every Fortune 500 company right now is in emergency mode, literally emergency mode of what are our supply chain scenarios? What happens if we get hit with tariffs in certain areas? What can we move quickly? What can't we move? And so that particular piece, we're not sure is going to be as helpful to inflation. Next slide. So what could cause an inflation resurgence? Well, poor economic policy, Some of you may know about the recent battle within the Republican Party over these HB1 visas and whether they were good or not so good. And again, major tariffs for China and Mexico. Supply chain snarls. World geopolitical hotspots are again bubbling at a pretty heavy level. The housing supply in the United States remains below needed levels, and so it's believed that rent costs are going to start rising again. This is after they kind of settled back for over a year after rising significantly before that. And then reshoring, moving supply chains closer to the consumer, i.e. the United States, and it's happening right now, that is inherently inflationary. So again, there's a lot of inflation pieces bubbling, even though right now inflation appears to be mostly under control. We also have a bird flu issue that is affecting our egg prices as we speak. Next slide. So here is the chairman of the Federal Reserve and basically what he said in December about Trumponomics, and that essentially he's saying with a lot of words here that they're tapping the brakes because they're just not sure what the policies are going to be. So tapping the brakes meaning on lowering interest rates from the levels that they've had them at. Next slide. So next slide, wild cards. Department of Government Efficiency. Musk, and it was Musk and another billionaire, Swami. Swami has now exited the scene, and they're recruiting a lot of experts, including a lot of techno billionaires from Silicon Valley, to figure out how to cost cut and create efficiency through slashing government jobs, trimming government waste, and technology productivity tools. Essentially what Argentina has done, except there was a world of hurt for Argentina for about a year. Now they've come out of it, and it is arguable that Argentina's economy may not be comparable to the U.S. at a number of levels. The original stated goal for Musk has been $2 trillion in federal budget cuts from a $6 trillion starting point. And he recently said, well, $1 trillion may be more realistic. On the campaign trail, literally a week before the election, he was telling the Trump faithful, expect hard times ahead temporarily, sort of AKA Argentina. Again, our suspicion is that the delicate balance we're in, that Trump will give Musk a short leash on some of this stuff. Trump does not want an Argentina situation that could tank the economy before the midterm elections, which are critical for the Republicans to win in 2 years. Next slide. So here's another one of those big wild cards, world of debt. Every time we have one of these shows, I always remind people, never, ever, ever just look at one number and base your entire decision-making on that one number. So if you looked at this just based on the total amount of debt, you'd say, wow, the United States has a lot, and that must be trouble. And China has a lot, but not as much. Maybe China's in better shape. Nope. In fact, the number you have to look at is debt as a percentage of the economic growth. And the United States has been pretty darn good here lately, and China is hurting in a lot of areas of economic growth. Next slide. So there has been a surge of federal debt since the Great Recession of 08-09, but the economy has surged also. So again, that's the always considered debt as a percent of the economy. Federal debt costs have risen as interest rates have increased, but 1/3 are being refinanced this coming year at lower rates. But as I mentioned earlier, that yield curve has kind of moved around. So everybody's holding their breath to see what those rates really are. But it's a pretty good bet that we're going to see a decline of the interest cost. And we really need that because you can see on the last piece there, that interest costs reached 18%, and that was above the 14% yellow line, some even call it the red line, considered more risky for federal deficits. And so again, we believe that'll settle back temporarily. Now, it is worth noting that federal holdings of treasuries have declined steadily in recent years to about 22%. Some of you may remember decades ago, there was a lot of fear because who was our number one holder of debt? China. And so, again, we are now internally financing more of our debt, much like Japan. And Japan has been at 200% plus debt to GDP ratios for a while, and they have not been significantly harmed. Now, whenever you get up to these numbers, though, again, the airplane starts to vibrate, and you just don't want to push these things too far. Next slide. And speaking of pushing things too far, these are the projections on the right-hand side of the annual deficit and then the total debt. And so the Trump administration intends to renew the Tax Act that was set to expire at the end of this year, and maybe even add some goodies in on top of it. Well, what you see here is that the annual deficits and the aggregate deficit on the bottom right, both the red lines that you look at, both are projected to go higher. And so while there's a lot of talk about slashing government waste and efficiency, we're not convinced at this point that the extra deficits caused by that red line are going to be offset by tariffs or government cutting. Next slide. For those of you who don't know the Penn-Wharton budget model, they do a very nice job, very in-depth job of looking at all the scenarios around the federal debt and deficit and all the moving parts. And so their base case is that we could go another 20 years in the United States. However, the fire-tested scenario that everything doesn't go just as planned suggests that maybe as soon as 7 years, we could see this deficit start to make a real difference on interest rates, on investing. And again, we think it might not even take 7 years for some of that to happen. Next slide. Mentioned geopolitics. Certainly the situation in China and Taiwan is more troublesome. The original estimates were that China might have the highest probability of invading Taiwan when the Chinese Navy was more built out. Original thought process there was 2030. But all that calculus now is up in the air. And there are concerns because China would like to get its hands on Taiwan's manufacturing capabilities. 90% of the advanced chips in the world are made in Taiwan. And the Chinese now believe that they need that technology, even with the announcement that was made yesterday on their own AI, that they need that technology to help save their own economy. Mark Cuban has said on numerous occasions, that's the Shark Tank guy, a billionaire who's invested in a lot of companies, both public and private. Mark Cuban has said on numerous occasions that we must stay ahead of the Chinese on this artificial intelligence stuff. And there is a belief that between espionage and actual other work going on, that we may be in a race where we have to up our game, essentially, to stay ahead. And not that long ago, the president of China said, be ready by 2027, meaning telling his own troops, his own generals, be ready to invade Taiwan. Is it more posturing to get concessions for what they want? For example, right now, China is forbidden from ordering NVIDIA chips. And yet they've been trying virtually every week through cutouts and espionage and you name it. They've been trying to get their hands on advanced chips. This is one where some of the sources that we know believe that the threat is credible, could be as much as 50% threat in the next 3 years. And one major outfit that we work with, they now stress test every single investment they do, public or private, with the thought process, what could happen if the supply chains in China or Taiwan were interrupted? Well, you start stress testing that stuff, that's a tough bar to jump over. Next slide. And U.S. officials now estimate 90% of semiconductors, 70% of machine tools used by Russian military are coming from China. So what's been happening is there have been more coordinated efforts by Russia, China, Iran, and North Korea, a few other countries on the economic side, but on the military side, those are the four main ones, to share things. So let's go to the next slide. Here's a few quotes from people who are in the know. And so I know we usually get a number of viewers from Australia. There's your Chief of National Intelligence, basically saying, we might have underestimated the magnitude of this emerging axis. And so this is one of those things, 96% of the time over the last decades, we have advised clients, okay, there's a lot of noise everywhere in the world. 96% of the time we should ignore it. Well, we're taking it a little more seriously now. We don't know for sure if it's the 4% that'll actually affect things for more than a 12-month period of time, but that is certainly causing us to be more cautious depending on client circumstances. Next slide. And here's U.S. Navy Admiral, commander of the Indo-Pacific Command, basically saying the same thing. And so, again, I think, the scenarios under Trump, not entirely clear what strategy Trump would use if some of these areas that are simmering go more hot than they already are. Next slide. So our take is risks are elevated in many areas. Uncertainty level is high, just a lot of crosswinds. And at the same time, opportunities are everywhere. And so it's a little hard for some people to keep those two things in their brain at the same time. But we suggest adding, as I mentioned before, non-correlated assets to portfolios that, like infrastructure, that will help diversify and have secular tailwinds. We also think hedging strategies for certain people make a lot of sense. And this concept of staying disciplined between your core and explore, can't emphasize this enough. It is so confusing for people. Let's say that they own NVIDIA and they're like, well, the downdraft yesterday was scary. Should I take half my chips off the table or take it down to some percentage of my portfolio? Well, if it's in the explore side, meaning dollars that you're never going to need for financial independence, hey, the old adage there is let your profits run and cut your losses short. If it's on the core side, meaning money that you really need for financial independence, don't do that in this environment. That is extraordinarily dangerous. So if you can really segregate your assets between core and explore, what you absolutely need for financial independence in the future and what is excess, if you will, that really is helpful trying to figure out what do I do tactically or strategically with certain more volatile assets. Next slide. And so again, figure out the core and explore, rebalance core to neutral targets aggressively, meaning quickly. Retirees, we advise them, don't stretch your risk levels in core. A lot of retirees did that for a lot of years because bonds weren't paying anything. But this is not a time to be a hero if you're a retiree. And explore funds, again, I've talked about the techno-industrial revolution. A lot of good ideas there. Small cap stocks have not participated as much on the upside, and they have, we think, a lot of room to run, and niche assets. We are telling our retirees, again, depending on circumstances, do they have a pension or not and what their living expenses are, but consider moving to a more elevated living expense in cash, like 2 years, so that if we hit some rough patches here, you're not selling stocks when they're down. And then item number 6, this is maybe never been as true as today in the last decade, but be prepared to pivot and adapt because there's a lot of stuff going on. Next slide, and we are done.
Well, that's good, Dennis. I'm just curious though. What is your outlook for 2025? Are you looking at this big growth, or are we looking at maybe not so big? Because it sounds to me when I was looking through your charts that we're looking at maybe 3% returns as opposed to double digits. Are you looking at a little bit more conservative returns now?
Yeah, we actually think it'll be better than 3 in 2025. And but it'll probably be 2 steps forward and 1 step back. So I mean, yesterday was a chilling decline for some investors, and so we think that sort of thing is going to continue. But generally for the year, it could end up being 8 to 10%, maybe even a bit better. But I stress here, everything has to go well. And there can't be any major hiccups in that. A major hiccup that would have a chilling effect on markets, and now that things have become a bit more dynamic in Ukraine, Russia, and we have now crossed Putin's red line yet again with weapons firing into Russia. If at some point we push that too far and Putin used a tactical nuclear weapon, well, that would create a chilling effect across all markets, maybe for a little period of time. The Middle East, the big powers held off pulling their punches. Israel delivered essentially a few near knockout blows to some of their enemies. So at least right now, it appears everybody's stepping back, taking a breath, and some of the countries, Arab countries that are interested in more peace than war, are saying, "Hey, let's all take a breath." But we tend to forget how much of our shipping goes through that area, including oil. Now, again, the United States is more energy independent now, so it's not quite as critical as it used to be. Some of that oil, but that could still create a chilling effect. So generally, the answer is semi-optimistic, positive for 2025.
All right. Another thing I found interesting is that the Boston Consulting Group said because the data centers are going to absorb a lot of energy, that the energy consumption could increase like 20%. Does that mean that the investor should start looking at perhaps energy stocks because of the data centers? Is that a possibility?
Yeah. So there's going to be different winners and losers in this. And so in the drill baby drill scenario that we appear to be having, that could cause energy prices to come down, which generally is not super positive for the big oil companies, the big energy companies. And so this is like Trump won, right? Everybody thought energy stocks would go up, but you get lower oil prices and their margins get squeezed and they don't behave as well. What's interesting, there was a point in 2024 where the number one performing area in the S&P 500 was, wait for it, not technology stocks, it was utilities. Yeah.
Well, some of the boring areas. Well, we do cover the national debt almost every week on economics with the Honorable David M. Walker, because it is a time bomb out there. We just don't know when it will explode. It's very interesting that your experts were saying 7 years to 20 years to we don't know how many years before it actually has a negative effect on people's individual lives. You mentioned the tactical nuclear weapons. We actually have a show that originates from Kyiv, Ukraine every week. And one problem that they have, and Dr. John Lockwood, who's on every week, he's actually in Washington, D.C., has mentioned the possibility of tactical nuclear weapons. If something like that was to occur, would that just jolt our financial markets tremendously?
Oh, yeah. So there is a peace dividend built into these stretch valuations. And the use of even tactical nuclear weapons that are, small scale would jolt the markets. Now, I'm not sure they would jolt them for more than 3 to 6 months. And it takes a lot. I mean, you go back in history, this is why we say 96% of the time, ignore all the spooky, scary things you read about on worldwide geopolitics, because it takes a lot to knock the markets off their stride for more than a year. And we very rarely had that happen. 9/11 didn't even knock it off for more than a year.
Okay.
So.
All right. So the thing is, generally people who have diversified good portfolios and good money managers like you, they can feel safe rather than sit there and worry about all the geopolitical and the trends in the particular market space.
If they have done good portfolio hygiene,
right,
which means good rebalancing
yes,
in their core portfolio.
Yeah. And rebalancing sounds to me that's probably the key for 2025, because one thing I've seen working with clients is that over a period of years, we've had like a lot of up markets since 2008, and most people haven't gone through 2008, but I remember going through it. It wasn't pretty. In other words, the market went down 37%, took years to recover. And so now we have a whole generation of people that have never experienced that jolt. And when they do, I have no idea what they're going to think about it. And so rebalancing can actually help people go through that. Let's put it this way, lessen the jolt. Well, we're about at the hour, so we do want to thank our special guest, Dennis Stearns from the Stearns Financial Group. You can read about him, you reach him on the internet to discuss the economics projections in 2025. And you'll be able to see this on, of course, YouTube, LinkedIn, Facebook, Twitter, which is now called X, also on our Roku TV channel and on Amazon Fire channel. And right now we are testing also through TikTok, because we believe TikTok will be around, at least it looks that way. But we do want to thank our viewers in the United States and around the world. And you'll be able to see this again, because we're going to be rebroadcasting this several times throughout the next couple months. Until then, take care, stay healthy, and stay wealthy. And we'll see you next time. Bye-bye.
Take care.